Have you ever felt like you're standing on the threshold of a dream, when everything you've worked for is finally within reach, just one step away? A young couple gazes at a house. They did everything right, saved diligently, worked hard, found the perfect location. The mortgage seemed like a mere formality. They were confident. But what if I told you that a soulless algorithm had already passed judgment on them, all because of an event they don't even remember? By the end of this video, you'll learn how to avoid becoming its next victim. The call came from the bank. A cold, formal voice informed them. Mortgage denied. No explanations. Shock. Disbelief. They reeled through every possible reason. Was their salary not high enough? Did they not have enough savings? But all the numbers added up. By all classic banking metrics like the 2836 rule, they were exemplary clients. The math was on their side. They were ideal borrowers. The system should have said yes. But it said no, and offered no explanation why. Their investigation led them to their credit history, and there, amidst a perfect record of payments, they found it. A debt of 2,000 rubles. 10 years ago, one of them had forgotten to close a contract with a mobile operator. The operator likely sold this debt to collectors for 1 to 3% of its value, literally 20 to 60 rubles. It had transformed into a digital stigma. No one called, no one wrote. But the invisible digital guillotine had fallen. 3 digits on their report erased years of hard work. This story is not an accident. It's the system's design. Today we'll answer 3 crucial questions. First, who created this digital monster that decides our fates, and why? Second, what secret rules does it follow, and why does it so often make mistakes? And third, the most important, how can you hack its code and make those 3 digits work for you, not against you? This monster didn't appear out of nowhere. It has creators. To understand their intent, we need to travel to 1950s America. Back then, getting credit was a personal conversation. You'd walk into a bank, sit opposite a manager, and try to convince them you were a good person. The decision depended on your handshake, your suit, your connections, and, let's be honest, the color of your skin. Bankers unofficially called it the 3 C's rule: character, capital, and capacity. But character was key, and it was assessed by eye. This was an era of legalized bias. And 2 men, engineer Bill Fair and mathematician Earl Isaac, decided it was time to end this chaos. Their idea was brilliant in its simplicity. Replace subjective human judgment with cold, hard math, to create a scoring model that would objectively assess risk by looking only at raw data. Interestingly, their first tests weren't for mortgages but for credit card applications at department stores. They analyzed thousands of questionnaires, found hidden patterns, and proved their model predicted bankruptcies far better than even the most experienced credit officer. Thus, Fair, Isaac and Company, or FICO, was born. Their goal wasn't to enslave the world, but to make it fairer, to give a chance to those the system had previously overlooked. For banks, this was a revelation. No more deliberation. Input data, get a number. Decision made. It was like Henry Ford's assembly line replacing manual labor. Credit scoring became a financial assembly line. It made the process hundreds of times cheaper and faster, but the craftsman, the manager who could delve into your personal story, was dismissed as unnecessary. The FICO score spread like a virus, first across America, then worldwide. It became the universal language banks used to talk about us behind our backs. But in the pursuit of this efficiency, something broke. Let's pause for a second. On an imaginary fairness scale from 1 to 10, the original idea, replacing a biased banker with an impartial algorithm, scores a solid 8. But what the system has mutated into today, a soulless judge that punishes for a forgotten debt from 10 years ago, barely scrapes a 3. The problem wasn't the idea itself, but its mutation. Today, this algorithm is a black box. We know what goes in, but not exactly how it arrives at its conclusion. FICO's precise formula is a trade secret, guarded as closely as the Coca-Cola recipe. Officially, it's to protect against fraud, but a side effect is that millions of people play a game without knowing all the rules. The algorithm considers hundreds of variables. But there are 5 key mortal sins that can tank your rating, even if you always pay on time. And now, we're going to crack open this black box and dissect each one. The first and most impactful lever, controlling 35% of your fate, is your payment history. Paid on time. Good for you. Missed a payment. Get a mark. But the devil, as always, is in the details. According to FICO itself, a single 30-day late payment can cost someone with an almost perfect score between 90 and 110 points. One missed payment, and you instantly go from an excellent borrower to an average one. A single 30-day late payment is a scar. A 90-day late payment is a verdict that will hang over you for 7 years. The system does not forgive or forget. This is its first and foremost rule. The second lever, weighing in at 30%, is your debt burden, or credit utilization. And here's the first shocking fact. The system doesn't like it when you have no debt, but it absolutely hates it when you use all your available credit. The ideal balance is to use no more than 30% of your available credit. Imagine your credit limit is your car's top speed, say 200 miles per hour. If you're constantly driving at 190, you look like a risky driver pushing the limits. If you're driving 60, you're in control. The algorithm reasons exactly the same way. High utilization is a sign of financial stress. And to the algorithm, someone who owes 90,000 out of 100,000 looks more dangerous than someone who owes 30,000. It's not about the amount of debt, but the percentage of control. Right now, take the limit of your primary credit card and the amount you currently owe on it. Divide the second number by the first. Did you get more than 0.3? If so, at this very second, the invisible algorithm considers you less reliable. This is a simple action you can take after watching this to instantly go green in the eyes of the system. The third lever is the age of your credit history, accounting for 15% of your rating. And here's the second shocking fact. Never close your oldest credit card, even if you don't use it. For the algorithm, a long history is a sign of stability and experience. It doesn't just look at your oldest card, but at the average age of all your accounts. Imagine you have a card that's 10 years old and another that's 2 years old. The average age is 6 years. Close the old card, and your average age plummets to 2 years. To the system, you instantly became younger and less experienced. By closing an old account, you are literally burning years of your financial reputation. It's like destroying your college diploma. The remaining 20% is divided between the last two levers, new credit and credit mix. Every time you apply for credit, a bank makes a hard inquiry on your history. Each such inquiry is a micro hit to your score. Too many inquiries in a short period of time. For the system, it's a cry of, "I'm desperate, someone give me money." But there's a loophole here. If you're shopping for, say, a mortgage, and make several inquiries with different banks within 2 to 4 weeks, a smart algorithm understands that you're rate shopping and counts them as one. But if you apply for a credit card, a personal loan, and a payday loan in 1 week, that's a red flag. The system also likes diversity, having a credit card, an auto loan, and a mortgage. This shows that various institutions trust you. Notice the paradox. To prove you can be trusted with money, you must constantly borrow money and diligently pay it back. The system punishes both those living on the edge and those who fundamentally avoid credit. It's a classic catch-22. To get credit, you need a good credit history. To get a good credit history, you need to take out credit. The system traps you in a logical loop, forcing everyone into a single matrix of rules. We've broken down the rules. But what if the data these rules are built upon is simply garbage? What if your digital biography contains errors you don't even suspect? In the next act, we'll delve into the world of digital ghosts, people whose lives have been ruined by a single typo in a database. The third shocking fact: 1 in 5 credit reports contains an error. This isn't a scare tactic. It's official data from a multi-year study by the U.S. Federal Trade Commission, FTC. 21% of people live with a confirmed error in their digital passport. For 5%, the error is so serious that they are either denied credit or given it at predatory rates. 1 in 20. This means that in a room of 20 people, at least one is a digital ghost paying for someone else's sins. And the system isn't obligated to find these errors. That's your job. Meet our first ghost. His life was ruined by a bankrupt namesake from another city. The algorithm mistakenly merged their profiles. In the industry, this is called a mixed file. Due to a shared last name and a once-matching zip code, our hero received denials for years, even for a simple credit card. He tried to prove to the system that he was himself, not the other guy with millions in debt. But to the soulless machine, they were the same person, a single line marked hopeless. Our second ghost is someone who thought they had beaten the system. They negotiated a restructuring with the bank or paid collectors at a discount. They breathed a sigh of relief. The story was over. But their report showed it as a stigma, debt not paid in full. To you, it sounds like a victory. To the algorithm, it's confirmation that you failed to fulfill your original obligations. This is almost as bad as an active delinquency. You paid, but the system didn't forgive you. For 30 seconds, let's become this algorithm. I don't see a person. I see lines of code. User ID, 34,576. Payment status, delinquent 90 days. Date, 2014-05-12. I don't care that your mother was sick then, that you were fired, that it was a bank error. I have no empathy. Nobel laureate Daniel Kahneman calls this an algorithmic verdict. It is devoid of human emotions, mood, and bias. But it is also devoid of context. It knows no compassion. I only have data, and based on that, I deliver a verdict. Cold, instant, merciless. The greatest injustice of the system is that it considers you guilty by default. The burden of proof lies with you. You are the one who must write letters, gather documents, call credit bureaus, and prove you're not a camel. Your carefully crafted letter with evidence is received not by a person, but by an employee who translates its essence into a 2- or 3-digit code in an automated system. This system sends the code to the creditor. If the creditor replies, "All correct," the bureau closes your case. It's a Kafkaesque labyrinth designed to make you give up. But what if I told you that this labyrinth can be navigated? That there are clear steps and even phrases that make this bureaucratic machine work for you? In the final act, we'll stop being victims and become hackers. I'll give you a 3-step protocol to take control of your digital destiny. Step 1. Audit your digital shadow. Stop living in ignorance. You have the legal right to receive your credit report free of charge twice a year. This isn't a request. It's your weapon. Get it, print it. Grab a red marker and interrogate every line. Look for unfamiliar credits, closed accounts the system considers open, old debts that should have long disappeared. Pay special attention to dates. Most negative records, whether delinquencies or charge-offs, have an expiration date by law. In the U.S., most negative records typically remain for 7 years from the date of last activity. Make sure ghosts from the distant past aren't haunting you longer than they should. Step 2. The art of disputing. Found an error. Don't call. A phone call in this war is like writing on water. It leaves no trace. Write an official dispute letter to the credit bureau. And certified mail with a return receipt is like carving your demand in granite. It creates a paper trail that will be your main ace if the matter goes to a regulator. Use the magic phrase, "Pursuant to the Fair Credit Reporting Act, I demand an investigation and a written response within 30 days. This wording triggers a legal mechanism. The Bureau is obligated to initiate an investigation. And if the creditor cannot documentarily prove their claim, and they often can't find old papers, the record will be deleted. Step 3. Architecting the perfect score. Stop fighting fires. It's time to tend the garden. Set up auto payments for all your credit accounts, even for the minimum amount. The human factor, forgetfulness, will be eliminated. You'll never miss a payment again. Keep credit card balances below 30% of your limit, especially at the end of the billing cycle. Few people know this, but the bank reports your balance to the bureau not every day, but on a specific date, usually your statement closing date. This means you can actively use your card all month, but a couple of days before that date, pay off most of the debt. To the system, you'll appear as if you barely use your credit. This is called balance micromanagement. And never close old cards. You are transforming the system's rules from shackles into tools. If you have a poor or non-existent credit history, there's a powerful, almost unfair trick. Ask a relative or friend with an excellent credit history to make you an authorized user on their oldest credit card. In the West, this is called piggybacking. You literally jump onto the back of someone else's ideal credit history. To the algorithm, it looks as if a very respected and experienced member of the financial community has vouched for you. Their impeccable reputation and the age of their account begin to work for you. You don't even have to use this card, but its history will reflect on your report and can give a powerful boost to your rating. And the final fourth step, credit hygiene and patience. Restoring your credit score is not a sprint, but a marathon. Think of it not as a broken appliance that can be fixed in a day, but as an overgrown garden. First, you weed out the errors, you dispute mistakes. Then you plant the seeds, you pay on time. And then you patiently wait for them to grow, for the age of your history to increase. There are no quick results here, but the outcome of consistent care is guaranteed. There's no need to frantically apply for 10 credit cards. That will only worsen the situation. One inquiry every 6 months. Slowly but surely, you rewrite your digital code. The system respects patience and consistency. What about our couple from the beginning of the video? They didn't give up. They went through all these steps. They disputed that old debt, which turned out to be an accounting error. They optimized their credit card balances. They waited almost a year, rewriting their history. And when they reapplied to the same bank, the answer was approved. They won not because they became richer. They won because they learned the rules of the game, hacked the code, and made the soulless system see them not as lines of data, but as people worthy of their dream. Let's summarize. Everything you need to remember comes down to 4 simple rules. Essentially, it's the financial version of trust, but verify. You trust yourself by automating payments, but you verify the system by requesting reports and disputing errors. First, check. Request your credit report twice a year. It's your digital health check. Second, dispute. Found an error. Immediately write a letter to the credit bureau. Don't give up. Third, automate. Set up auto payments. Eliminate the human factor. And fourth, control. Keep credit card balances below 30%. This is the golden rule. A credit score is a tool. Like any tool, it can build a house or become a weapon. It's like the myth of Prometheus. As long as the knowledge of how fire worked belonged to the gods, it was merely a threat to humans. But once Prometheus brought them that knowledge, fire became a tool for the development of civilization. Knowing the rules of the credit system is your fire, stolen from the gods. For decades, we allowed it to be a weapon against us. But knowing its rules transforms us from slaves of the system into its masters. The choice of who to be is now yours. And now, the main question for you. After all you've learned, what do you think? Is the credit score in its current form a necessary tool for risk assessment, or a digital prison that needs reform? Write just one word in the comments: tool or prison. I'm very interested to see which will be more prevalent.